Dividend yield on cost takes stupid impulses out of investing. Among almost any academic investor that you could possibly meet, the notion of caring about yield on cost is quickly dismissed as fool's play, the hallmark of an unsophisticated investor. What is yield on cost, and why is it so quickly dismissed? There are two types of yield on cost: dividend yield on cost and earnings or free cash flow yield on cost. It's a comparison between what a company's business performance is doing for you right now and the amount of cash you had to set aside to make that investment happen. I'll use the most famous investment in North America, Warren Buffett's purchase of 400 million shares of Coca-Cola, as an example. From 1988 through the early 1990s, Warren Buffett spent $1.3 billion gobbling up shares of America's signature soft drink company, Coca-Cola. As we flash forward to 2014, those 400 million shares of Coca-Cola could be sold for a little over $16 billion. That information is very useful if you want to sell your ownership in the business for obvious reasons, but it doesn't tell you about the actual current business performance of Coca-Cola. At the time of this writing, Coca-Cola is generating $2.08 in profits for every share that you happen to own, and the board is elected to pay $1.22 of those profits to shareholders in the form of a cash dividend. It pays out about 60% of its profits to current owners and keeps 40% of profits on hand to grow the business so that it can pay more dividends and generate more overall profits so that the stock price will go up over the long term for its owners. Applying that to Buffett's sizable investment, we can see the following. The 400 million shares represent $832 million in profit. More tangibly, those shares represent $488 million that will get sent out in cash dividends to Berkshire Hathaway's headquarters at Kiewit Plaza in Omaha. What does the yield on cost signify for those figures? Based on Buffett's $1.3 billion investment, his dividend yield on cost is 37.53%, 488 divided by 1300, and his earnings yield in cost is 64%, 832 divided by 1300. It's a great way to see how the passage of time and business growth make the initial amount of money that you set aside to invest in a stock work harder and harder on your behalf. It's usually dismissed as a mental gimmick because you aren't actually receiving a 37% dividend yield if you buy the shares today, but rather, it's the 2.9% yield that the shares are yielding now that is significant if you are making buy or sell decisions. Also, financial advisors have a fear that investors will act to their detriment by holding a collapsing security if they refuse to part with something that is paying half as much in total dividends as you initially invested in the stock. But for the very reasons most academics hate it, I happen to love it because it's a way to get you to focus on actual business performance instead of stock price. I like to look at what my money is doing over time as it relates to the business performance of the company. That's what is durable. That is what is self-sustaining, and with non-cyclical companies, less subject to whims in the economy. Stock prices are nothing but the bandwagon fans that raise things up and get interested when the team is doing well and say sayonara as soon as times get a little bit tough. Who wouldn't want to reach the promised land of investing where setting aside $10,000 in a company becomes such a growing ownership stake that it one day starts generating $10,000 in profits per year and eventually starts paying you as much in dividends as you originally invested into the company? I see it as the ultimate chill pill in long-term investing. How could you worry about cratering prices when you received as many dividends from your stock investment as you invested in total into the company? It's a lot easier to handle a stock falling in price from $60 per share to $30 per share if you collect in cold hard cash the total amount that you invested into the company during the scope of that price decline. Long ago, Warren Buffett had a great quote about how we'd all be greater investors if we had a punch card that only allowed us to make 20 total investments over the duration of our lifetime. It has the great effect of keeping your head focused on the right thing. The business performance of your companies and the amount of cash that you get to receive each year for being an owner. It's the best way to measure the long-term, productive use of a particular pool of money. You're not going to panic sell something that you've bought and are set to receive a large portion of your original cost from in the form of a dividend over the course of the year. Yield on cost investing is a safeguard against impulsive selling just because the price declined.